Good morning, class. How are you all doing? I hope you are doing very well. So, today we are going to start the past adjustment of our chapter Partnership Fundamentals. So, today we will deal with past adjustment. So, before going through the past adjustment, we must know what exactly the past adjustment means. So sometimes after preparing the accounts of the firm, it is found that mistakes related to interest on capital, interest on drawing, salary to partner, etc. are committed or omitted, or any amount is wrongly entered. Therefore, for the purpose of correcting these omissions or mistakes, adjustment entries are passed through profit and loss adjustment account, in which adjustments in respect of each and every omissions are to be made. However, an adjustment entry can also be passed in journal. So the entries are recorded for the errors made in past. For that reason only they are called the past adjustment. These are some types of omissions or errors like interest on capital, that we have omitted to provide interest on capital, interest on drawing, that is we have not charged interest on drawing, salary to partner, that is we might have not provided salary to the partner, commission to partner, that is we need to provide the commission to the partner and we have not yet provided the commission, interest on capital or drawing provided at higher or lower rate, that is whatever the amount we need to provide, the interest rate would be lower or higher, and hence it would create the omission or mistake or errors. Now class, past adjustment, we have to understand the exact what happened here and how these things are to be made error free and to change or to adjust the account. Now what happened, like interest on capital or drawing is omitted, allowed or charged at higher or lower rate, profit or loss are distributed among the partner in wrong ratio, and so on. So these errors and omissions are rectified by adjusting the capital accounts of the affected partner by passing an adjustment entry or adjustment entries. Class, you can see clearly we have two words, that is an adjustment entry or adjustment entries. That is, it might be possible that there is only one omission, so at that time we will just pass an adjustment entry, and if we have the multiple omissions or errors, we will go with adjustment entries. So class, here a statement showing adjustment, that is an analytical table, is present here. We have to find the mistake by using this analytical table, because this is quite easy to understand and you can easily apply once you get into the type of the question, and we will going to discuss such type of questions in this session too. So here see, we have the column, that is particulars column, A and B, that is partners column, and one is firm column. So what we need to do, we have to provide the wrong appropriation. Okay, that is the profit wrongly created. So what we are doing here, what we had given earlier, we will revert it back. Okay, so in partner A it will be debited, in partner B it will be debited, and in firm it will be credited. Now we have to find the correct appropriation, that is appropriation to be taken into account, like interest on capital. So partner's capital account would be credited and firm account would be debited. Salary or commission, partner capital account would be credited and firm's account would be debited. Now interest on drawing, partner's capital account will be debited and firm's capital account would be credited. Net divisible profit in PSR, so partner's capital account would be credited and firm's account would be debited. Now we will get the net effect, that is we have to minus the amount, that is wrong appropriation minus correct appropriation. So at that time we will get debit balance or credit balance and so on. Now we have the adjustment journal entry too. So in journal entry, what we will write, we will do with deal with gaining partner capital account debit to sacrificing partner capital account. Whosoever the partner is gaining, okay, so at that time we have to debit his account. So gaining partner capital account debit to sacrificing partner capital account. Now in past adjustment, it is not necessary that capital account of all partners are affected. So more than one partner's capital account may be debited or credited, but amount of debit and credit must be equal. So to understand this line, we have one question. See class, one question is provided here. We have the partners A, B and C who are the equal partner. We have the profit and loss account. We have the net profit of 3 lakh rupees. Now see, 3 lakh rupees has been distributed among A, B and C equally. So after preparing this profit and loss appropriation account, we found that it was noticed that interest on capital was not charged. Interest on capital was not charged to A rupees 12,000, B 9,600 and C 10,500. This amount to be charged as an interest on capital. Moreover, here the firm has not charged interest on drawing, that is amount 1200 and 900. That is, firm need to give interest on capital, provide interest on capital of 12,000, 9,600 and 10,500, and firm will charge interest on drawing from A and B as 1200 and 900. So this one is the wrong profit and loss appropriation account. What should be done? This should be done. See, by profit and loss account, net profit 3 lakh will be there. Now interest on drawing, this amount is the income for the firm, so 2100 will go at the credit side. Now interest on capital will come as 12,000, 9,600, 10,500. So after deducting 32,100 from 3 lakh 2,100, we will be provided with 2,70,000, and this 2,70,000 will be distributed among the partner in the equal ratio. This is the profit and loss appropriation account that we need to create, or that is what expected from the partnership firm. So here, from the corrected profit and loss appropriation account, this is ascertained. What is ascertained? See, credited short for IOC. So A's capital account 12,000, now B's capital account 9,600 and C's capital account 10,500. Now debited short for IOD, debited short for IOD, that is 1200, 9,600 and nothing for C. Now according to analytical table, what we will do? We will do the deduction, that is from the wrong appropriation to correct appropriation. So 32,100, okay, that is IOC minus 2,100. Okay, so we will get 30,000 that should be distributed, that is credit excess as share of profit equally. So 10,000, 10,000, 10,000, we will get the net effect of 800 positive credit sorted, 1,300 as a negative balance and 500 as a positive balance. Now we have to deal with in this way. So B's capital account debit to A's capital account to B's capital account. Okay, so B's capital account. So class, that was some mistake in typing. So it would be B's capital account debit to A's capital account to C's capital account. Now 1,300 will be distributed among A and C. Now see, we have this one, that is credit sort for IOC 1200, 12,000, 9,600 and 10,500. Debit sort for IOD, that is interest on drawing 1200 and 9,600, that we did minus. Now what would be the amount that is credited excess as a share of profit, that is 32,100 plus, that is 12,000 plus 9,600 plus 10,500 minus 2,100 of interest on drawing, we will get 30,000 that should be distributed equally among A, B and C. Now we will get 800, 1,300 and 500. So A is short with 800, excess is amount with B of 1,300 and C is with more amount of, sorry, short amount of 500. We will do this entry, B's capital account debit to A's capital account to C's capital account. Okay. Now class, we are moving toward the second example. Okay, see, the question is P and Q are partners in a firm sharing profits equally. Their fixed capital were rupees 1 lakh and 50,000 respectively. The partnership deed provided for interest on capital at a rate of 10% per annum. For the year ended 31st March 2016, the profit of the firm were distributed without providing IOC. Now, what happened here? The firm has not provided interest on capital, okay, and the rate of interest on capital was 10% per annum. Now, what would be the amount of interest on capital to P? It would be 10% of 1 lakh 10,000 rupees, 10% of 50,000 5,000 rupees. So total IOC, that is interest on capital, would be 15,000. So this above IOC has not been credited to the partner. It is to be credited to partner's current account, resulted in a loss of 15,000 to the firm, because firm needs to give this amount to the partners, which is to be debited to the partners in profit sharing ratio, that is equally. So what to be done here? See, interest on capital, partners account will be credited 10,000 and 5,000, and firm's account will be debited. How much? 15,000. Now for sharing the above loss, we will share that amount equally. That is, half of 15,000, it will become 7,500, 7,500, and firm account will be created. Now what happens here? See, debit amount is 7,500 and credit amount is 10,000. In the same way, in Q column, debit amount is 7,500 and credit column is 5,000, and in firm it's equal 15,000, 15,000. So after deducting this amount, we will get that 2,500 credit and 2,500 debit. What we have studied in the very first, that is debit and credit should be equal. So what we will write here? Q's current account debit to P's current account. See again, we have the balance amount that should be adjusted, and this is the adjustment entry. Okay, so class, this was whole for the past adjustment. We will deal with the some of the questions today, and through doing the questions you will find that parts adjustment is very much clear, because as much the number of question you will do, you will find that past adjustment is not very tough thing, and you will get all the things very clear soon. Okay class, thank you very much.